Okay, sorry guys, sorry to have kept you waiting for a bit. But anyways, I hope that it's all fine now. So welcome to this SBR Revision Marathon session. This is Luqman Rafiq, the tutor for the course SBR. Let me just give you a bit of a guidance that what exactly is the agenda for my session of today. What I will be doing is that I personally think that rather than me taking the lead in this specific session, it would be an amazing thing if we could actually make it an actual revision session. How would we be able to make it an actual revision session? So in order to make it an actual revision session, the best thing would be that what we should do is that we should try to actually make sure that I take up as many queries from you people and I solve those queries. I help you understand those queries. But before that, let me just give you a bit of an idea. Let me just give you a bit of an overview, because I know what actually happens is that a lot of the students at this point of time, they would be thinking that we might do this X standard, we might do this Y standard, we might do this current issue, we might do that current issue. So a lot of things actually come to your mind at this point of time. And I think the best approach that everyone should understand whenever you are attempting any paper is an 80-80 rule. Is an 80-80 rule. Now, what exactly is this 80-80 rule? Let's try to understand. There are people who have got this specific mindset that we are only gonna pass if we attempt 100% of the paper. That's one of the mindsets. But to me, this is an incorrect mindset. This is an incorrect approach. I would rather believe upon an 80-80 rule. What exactly is that 80-80 rule going to be? So to me, this 80-80 rule is going to be that what you should try to do is that if you try to do 80% of the paper during the examination, and if you do this 80% correctly, 80%. So resultingly what happens is that this 80 into 80 is going to lead you towards 64 marks. This may not be the first time that I may be discussing this. This may be that multiple times I've discussed this approach, but believe me, this is what the approach is. Believe me, this is what the reality is. Believe me, this is what the realistic approach is, that you should adopt an 80-80 rule. Now, what do we mean by adopting an 80-80 rules? That is, you do the paper 80% correctly and you do 80% of the paper and you end up getting 64% marks and you end up passing. Now, as a student, what we do is that we try to spend a lot of time studying those areas of the syllabus which we don't actually understand. And end of the day, what happens is that we are sort of stuck in getting through the new areas at the point of time when we should be revising the old areas. So my suggestion to you all is going to be that there could be, let's say, 30 areas of the syllabus, and there could actually be 5 areas of the syllabus which you might know nothing about. And from the past trend and everything, you do have an idea that these areas might constitute 10 to 15% of the paper. So, okay, if these areas constitute 10 to 15% of the paper, and if you spend, let's say if you've got 25 or 30 days to prepare, and if you spend 5 days in them, and at the end of the day, you are standing in a situation where you don't actually know what you have studied in these five papers. So where are you going to stand? You will actually be standing in a position where your time would have been lost. So my suggestion to all of you is going to be that what you should do is that you should actually not focus on these areas which are very small portion of the syllabus and which you are not very good at, unless and until you've revised the rest of the syllabus, unless and until you have gone through the rest of the syllabus. Otherwise you should not go through these specific areas of the syllabus. That's one thing that you should keep in mind. Now, what about the other things? The second thing is that when you are attempting the paper in the examination, again, just make sure, even if you do 80% of the paper correctly and you do this 80% paper very well, you would be able to pass. The examiner is not expecting you to attempt 100% paper. There is no negative marking that you have not attempted this part of paper, you have not attempted that part of paper. There is no negative marking for that. You don't have any negative marking. You get it? You don't actually have any negative marking at all. Now, that's one area. Now, with respect to SBR, there are some portion of the syllabus which are must to do. They are to do areas and you should always be doing those areas. Now, what exactly are those areas which you should always be doing? So let me just give you a bit of a guidance. You see, group accounts is one of those areas which is something you just cannot skip. You cannot skip group account at all. You have to make sure, you got to make sure that you do the group accounts. Without doing the group accounts, you cannot pass this paper because from the examination perspective, I repeat, from the examination perspective, the question number one is actually of group accounts. And that question number one is of 30 marks, of which approximately 15 to 20 marks are pertaining to group accounts. So if you're gonna skip the group accounts, you're gonna be at the losing end. So this is an area which is to do, that is must to do. So you've got all types of the group accounts things, whether you talk about the step acquisition, whether you talk about the group disposals, the group cash flow, or you talk about the foreign subsidiary, etc., etc. So every single thing is going to be important. So when we talk about the concept of group accounts, so the concept of group accounts is that the group accounts needs the complete coverage. You need to have a focus on foreign subsidiary, the group cash flows, the group disposals, the step acquisition. Every single area of the group accounts needs to be covered up. That's the first important area. Now what next is there? The next situation is you have to make sure that there are some key accounting standards which are important for you to do, and that includes what? That includes the accounting standards IAS 12, the income taxes. Then there is this IAS 19. IAS 21 is already covered when you do the foreign subsidiary. Then there is this basically um, the IAS 36 impairment, the IAS 37. Then similarly, what happens is that you've got the IFRS 2, you've got the financial instruments area, you've got the leases, and you've got the revenue, IFRS 15, IFRS 16. Now, to me, if you do have a good grip over these areas, you are actually looking at approximately 35 to 45 marks in the examination. So having a look at these areas, you are actually looking at 35 to 45 marks in the examination. That's also important area. Now, the next thing is that, so I've actually told you one thing, which is basically the group accounts. I've told you something which is basically these accounting standard. This is 35 to 45 mark of the area. Now let's move a bit forward and let's have a bit further discussion. Then you have got, then you have got the interpretation of financial statement. And nowadays what happens is that it's not just about the traditional ratios, but there are these alternate performance measures. There are these alternate performance measures which you should actually know, which is what are the non-financial performance measures, what are the financial performance measures, so on and so forth. So there are different things which you actually would have to do. So basically that is something that you would have to do. Now, just keep one thing in mind. I repeat, just keep one thing in mind, that when we talk about this SBR paper, it's a very lengthy paper. It's a very lengthy syllabus. And you have to make sure that you narrow down the syllabus for yourself. Till the time you don't narrow down the syllabus for yourself, you would be lost. Now, lastly, there was a time when this was a P2 paper. Now it has become SBR paper. It is no more a P2 paper. So I repeat, when it was a P2 paper, there used to be questions that used to come pertaining to the different accounting standards. Now, what were the different accounting is like? There could be IFRS 5 scenario, there could be IAS 40 scenario, there could be, let's say, IAS 36 scenario, etc. So like for example, if there was a question which was worth 10 marks, now what actually happens is that you used to get 5 marks for just stating the accounting standard. Nowadays, things have changed. I repeat, nowadays things have actually changed. Now, what are the changes that have happened with respect to all of this? The things have changed in this specific manner that you don't get these 5 marks. Even the question does not, they don't even ask a 10-mark question. They might only ask for 6-mark question. So you got to make sure that you stay focused with the case study. You got to make sure that you stay focused with the case study, whatever case study you have, you stay focused on that case study, you stay focused on the information that is being asked. That is something that you have to focus upon. So always remember that if you have to prepare for this SBR, I would I would recommend you people that you take up the past paper, even if you take up the revision kit. There are few areas which you should actually, the way to prepare for this is that go question wise. Go question wise. How question wise? First of all, you should try to do all the question number one for the last, let's say 8 to 10 attempts. That's gonna give you 10 question practice. Then similarly, you question number two for at least last 6 attempts. So that means I'm recommending you 10 questions from the last 8 to 10 attempts. I'm recommending you 6 questions from the question two. Why am I saying question two? Because the question two that is examined, there are multiple types of things that are examined in the question number two. What are multiple things that are examined with respect to question number two? At times there is an ethical scenario that is examined. At times there is a specific accounting standard that is examined, but majorly it's the ethical scenario that's going to be examined. So you would get an idea that how the ethical scenarios are going to be answered. And for the question 3 and question 4, I would suggest that for the question number 3, you do these 10 attempt past paper. But for the question number 4, again if you do 10 attempt, so ignore the current issue area in those. There is not the current. So technically you would be doing 5 questions because half of the question is for the current issue, half of the question is not for current issue. Now, why would I say that you skip the current issue area? The reason that I'm saying that you should skip the current issue area is that because the current issues, they have changed over a period of time. Now I think something that was a current issue 3 years ago is no more a current issue. Something that was a current issue 4 years ago is no more a current issue. So you got to make sure that you ignore them. Now, what next do you have to do? Irrespective of whatever book that you are using, whether you're using BPP or whether you are using Kaplan. In usually the Kaplan, you've got a separate chapter for the current issues. And in BPP, you've got current issues at the end of almost every single chapter that's there. So ideally what I would recommend you people to do is that you actually refer to your friends and you take that current issue chapter from the Kaplan. Like you can get it copied, you can get it scanned, or you can, I mean, arrange for yourself from some way or the other this current issue chapter from the Kaplan book. And what you should do is that if you really want to do the current issues, just go through this Kaplan book for the current issues. That's one of the areas for the current issues. The second thing that you should be doing is that in addition to the Kaplan book for the current issue, what you try to do is that you pick up the articles. You pick up the articles which are there on the ACCA's website and match those articles with the current issues that are actually mentioned in the Kaplan book. So like for example, if the cryptocurrency is the current issue in the Kaplan book, you could take out the article for the cryptocurrencies. If the blockchain is one of the area, you pick up the article for the blockchain. If basically the disclosure requirements for the financial instrument is a current issue, you pick up the article for that financial statement disclosure and you read through the article. And believe me, let me guide you something. At times the examiner's article are very difficult to understand. I repeat, examiner's article are very difficult to understand at times. So it's always advisable that you could refer to the language of the BPP or the Kaplan book that is relatively easier to understand at times the examiner article, because at times those articles are sort of reflecting the case study. Even the fonts are not very good. There are a lot of things which actually make it difficult for you to study the article. So what I would recommend, what I would suggest you people is that focus this way. So basically, the important aspect of SBR is that don't think of gigantic syllabuses, don't think of gigantic courses. Just make sure that you narrow down your studies. Just make sure that you narrow down your focus, because once you're going to narrow down your focus, you would have greater grip over the areas. And again, my suggestion is 80-80 rule is what is going to take you through. 80-80 rule is what is actually going to take you through if you really want to do. Uh, you can't hear me now? Am I not audible? Okay, because there was a student who was complaining about it. So anyways, so that is what my suggestion is to all of you who are actually preparing for the SBR. So that's the starting point for today's revision session, that you got to make sure that you have your focus right. If you would have your focus right, it's going to be good enough. So I've also recommended you that you should do these 10 plus 10, 20, approximately 31 questions is what you should do. Now, one thing that I would like you to understand is that when we answer the questions, um, and when we look at the examiner answers, we sort of get depressed. Why do we sort of get depressed? Because he's talking about a lot of technical aspects, and we are like that we didn't even went through those technical aspects. He's talking about such huge technical aspects. So don't worry about it. Why is it that you don't have to worry about it? The reason being that he is the examiner. He has been writing the answers by sitting at home or by sitting at workplace. He has had ample amount of time to compile the answer. He had the open books available in front of him, and he had actually compiled the answer in a very easy scenario. You are in a pressure situation. You are doing the exam. You're not the examiner. You're not doing an open book examination. So what is it that you need to do? You got to make sure that you look at the marking schemes. I suggest that you look at the marking scheme, because a lot of his students focus upon doing a lot of practice. But I would recommend that study less, but do a quality study. It does not matter that you have done 20 questions and your friend has done 50 questions. Again, if he has done 50 questions and if he is still not getting it right, that means you are better off by doing only 20 questions and making the same amount of mistakes. So just focus on your mistakes, focus on picking up the areas, and just again restrict yourself. Don't try to spend time on those areas which are going to take a lot of time, but at the end of the day you would be standing in a situation where you would be not getting the grip on those areas. Okay, okay, okay. Now, so my approach is going to be that I would want to teach what you people want me to teach. I would want you people to teach what you want me to teach. I don't want to teach on my own. So I would actually I would be inviting the queries from you people. Whatever queries that you people are going to ask me, let's say if somebody has an issue with financial instrument, somebody has an issue with area of, let's say, operating segment, whatever your problems are, you could just keep on asking those questions and I will be happy to answer those questions. I generally start off with the alphabet A whenever I do my sessions, but today I would actually start off from the end. So I would start off with Z. So the last name that I could actually see is that I don't know why I could have a different name now. Waliul Hasnan is the student whom I am actually going to start off with. So Wali, if there is any specific area that you would like to ask questions on, any specific area that is troubling you, bothering you, let me know. I'm going to try to explain inshallah right now. If I think that I cannot do it right now, I might actually ask you for time. Mhm. Okay, no worries. Thank you very much, Wali. And in the meantime, as the class progresses, if I would suggest that you stay back here and listen to what the other students are asking. You're surely gonna learn a lot. Plus, in case if you think that you have got any further queries, you may just type it out on the chat window also. Okay, I've got Vivek Sethi. Vivek, do you have any queries? Do you have any questions? Yeah, Vivek, do you have any questions? Okay, I've got Samir Sadek. Samir, do you have any questions? Samir, any areas that are troubling you, that are bothering you? Okay. Consolidation, step acquisition, um, and disposal. Okay, Mike Akot, I'm getting your queries. I'll just answer them. Just wait a bit. Okay, Samir Sadek is saying is consolidation, step acquisition, and disposal. Now, any specific area in step acquisition and disposal, or is it the complete step acquisition and disposal that you're having problem with? Okay, control to control. Good enough. Now, let's just have a discussion about it. So basically, what happens is that uh, at times what happens is that there are step acquisition scenarios. And when we talk about the step acquisition scenarios, like there could be one of the scenarios where you had 20% shareholding and you go on to 60%. At time you have a 40% shareholding, you go to 60%. So in both of the cases, the control actually changes. But if you already had 60% shareholding and if you have increased your shareholding to 85%, so resultingly the control does not change. Resultingly the control does not change. Now, so how exactly do we actually account for such type of a transaction? So we need to understand this. IFRS 10 is the relevant accounting standard that applies on it, and IFRS 10 says that look, this is an equity transaction. So what does IFRS 10 says? IFRS 10 says that it's an equity transaction. Now what do we mean by equity transaction? That means you are holding the equity of the entity. Now you have enhanced your equity. You were the equity holder. You have purchased your own equity. That's what it means. Now, so what exactly do you mean by this? So this actually means that you have to calculate a gain or loss on further acquisition. You have to calculate a gain or loss or further acquisition and recognize gain or loss within equity. So in case if you had a company which you were already controlling and you acquire additional shareholding in that company, so what happens is the control does not change. Now if the control does not change, what is it that you have to do? You have to make sure that you calculate gain or loss on this further acquisition, and that gain or loss has to be recognized within the equity. Now how exactly are we going to do it? Let's just see. So for example, you had a 60% shareholding, and if you have increased your shareholding to let's say 85%, so that means your shareholding has increased by 25%. Now, what would happen is the gain or loss is going to be calculated like this. You would say the consideration paid, you would say consideration paid. Let's say in order to acquire this 25%, you paid $100 million of the consideration. So that was an outflow from your pocket. Now, the NCI acquired. Now, what exactly do we mean by this? You see, already originally the NCI here was 40%, and now NCI has remained 50%. So this 25% shareholding that you've acquired, you've actually acquired the NCI stake. So this is the NCI stake that you have acquired. So what are we going to do? We're going to say what was the NCI carrying amount at 40%. Let's say the 40% NCI was actually worth 90 million. Let's say 40% NCI was worth 90 million. So what is actually going to happen is that 90 million was the NCI which was representing 40%, and we have acquired 25% out of it. So I repeat, 90 million was the NCI that was acquired and it was representing 40% of the NCI, and we have acquired 25% of out of it, which is 56.25. Hence resultingly our 56.25 holding that we have acquired, we have paid 100 million for that. So resultingly, what is actually going to happen is that there is going to be a 43.75 loss that's going to arise on this. I bet there is a 43.75 loss that is actually going to arise on this. Now, how exactly are you going to record the transaction? So in the individual financial statement, the accounting entry for the investor or the parent is going to be 100 million debit and cash credit 100 million. But when it comes to the group accounts, what is actually going to happen is that you don't actually show, I repeat, you don't actually show the investment, but rather you show, just wait a bit, just wait a bit. I think that there is a some error with the camera, so just wait a bit. Yeah, now I think it's okay now. So basically when it comes to the group accounts, what is actually going to happen with respect to the group accounts? With respect to the group accounts, you don't show investment, but rather you show the goodwill. Now what actually happens in the group account is going to be, we are going to say investment is going to be credited by 100 million. So investment is credited by 100 million. Plus the second thing that is actually going to happen is that you're going to say that the NCI is going to reduce. NCI is going to reduce by 56.25. I repeat, the NCI is going to reduce by 56.25. And then secondly, what happens is that you would actually say the other components of equity, which is going to be shown within the equity elements, you're going to say 43.75 debit. Because whatever loss is, we are not going to show it in the P&L. We're not going to show it in other comprehensive income, but we are going to show it within the equity. I repeat, we are going to show it within the equity. So basically, always remember that either it's gonna be the individual financial statement or it's actually gonna be group financial statement. So in the individual financial, you just say investment debit, cash credit. But in the group financial statement, you recognize gain or loss on this acquisition, and that gain or loss is recognized within the equity area. Now let's just move a bit forward and let's talk a bit further. Similarly, when we talk about the disposals, so there are basically different type of disposals. One of them is basically classified as a control loss transaction. The control loss transaction could be from 80% you could reach 0%. From 80% you could reach 10%. From 80% you could reach, let's say, 30%, so on and so forth. That's a control loss transaction. Since the query that is being given to me is where the control is not lost. So I'm just gonna stay focused because my again agenda is I want to answer what you want to hear, right? So there is at times a disposal where the control is retained. Now what exactly do you mean by this? You had a 80% shareholding and your shareholding is now reduced to 65%. I repeat, you had a 80% shareholding in the company and your shareholding is now reduced to 65%. What exactly are you going to do from this 80% to 65%? Try to understand this. You're going to say that if my shareholding is reduced from 80% to 65%, so that means I have disposed of 15%. So again, what is going to happen is that this is an equity transaction. You're going to calculate the gain or loss on disposal, and this gain or loss on disposal is going to be recognized within the equity. Albeit you're gonna calculate a gain or loss on disposal, and this gain or loss on disposal is going to be recognized within the equity. Now, how exactly is it all going to happen? Let's just try to see this. Basically, this is all gonna happen like this, that you're gonna say that let's say this gain or loss is gonna be like this. Disposal proceeds. Let's say the disposal proceeds are 50 million. You have disposed of 15% holding. The disposal proceeds that you have got is 50 million. The net assets and the goodwill need to be established. The net assets, let's say 130 million is the net assets. Let's say 50 million is the goodwill of this business. So resultingly 180 million is the total amount that this business has. You had a 130 million net assets, you had a 50 million goodwill. Now what has actually happened with respect to this disposal is that you have actually you've actually transferred 15% of this amount to the non-controlling interest. So basically 15% of this 180 is gonna be 27. Hence, resultingly, there is going to be a gain of 23 million. I repeat, there is actually going to be a gain of 23 million. What's gonna happen is that there's actually gonna be the gain of 23 million. A gain of 23 million. Now, let's just try to understand this. When we talk about this gain of 23 million, how would we record it? We would say cash debit by 50 million. We would say the non-controlling interest credited by 27 million. Why? Because if we are disposing off, who's getting the return? Who's getting the shareholding? The non-controlling interest share is increasing. So if the non-controlling interest share is increasing, so what is actually going to happen is that the increase in the non-controlling interest share would actually be 27, and resultingly what else is going to be there? You're going to recognize other component of equity to be credited by the remaining amount, which is 23. Which is 23. Is that okay now? Okay, Samir, does it answer your query? Yes, Samir, does it answer your query? Okay. Okay, even if you have got proportionate method, even if you have got full goodwill method, both of them is okay. It's the same thing. Why the balancing figure go to other component of equity? What if it's acquisition of more, that is reduction in NCI? Okay, just wait a bit, Kilani, just wait a bit. I'm gonna come back to you. Samir Sadiq, you're saying, but in this tick, okay, it's the same for the proportionate method and the full goodwill method. It's the same. Mike Akoto, that why are you saying other component of equity? Because you see, you don't say other component of equity. I could even say other reserves also. That is also the same thing. I could say other reserves also, my friend. I could say other reserves also. Okay, I can go to working. Here you go. This is where the workings are. Okay, Kilani, your question is what if it's acquisition of more, that is reduction in NCI? So do you mean to say that the control is lost? That's what you mean to say, Kilani? I still don't get it. I mean, like in this example, what change do you want? You're talking about a step acquisition? You're talking about when you increase when the NCI percentage increase, that's what you're talking about? Okay, that's what I just explained to you right now, my friend. Just a while ago, step acquisition, where there was 60% to 85%. That means uh, we had a shareholding of 60%. Now we went on to 85%. That means our basically our um, investment increased, right? So we increased 25%. And whom did you buy this 25% from? The NCI. So I said we have to calculate gain or loss in that case also. Is it what you're asking? Can you just see? Yeah. Do you understand this? Okay. Can you just see the entry now? Okay. Um, you want to see what is it that you want to see, Samir? Is it okay? Have you seen it? I can just zoom out in case if you want. I've just zoomed out. You could see. Yeah, you will receive the notes after the session. You will receive the notes after the session. Yes, you will receive the notes and you'll receive the recordings also. Now, okay, so I got over, I started from the bottom. Next, I've got Salvin George. Salvin George, you have anything to ask? Okay, apparently nothing. No worries. Rebecca, how are you? I'm good, I'm good. Good to see you after a long time. So, any queries that you have, any specific areas that you need support in? Hmm. Okay, now let me just guide you that when it comes to this financial instrument, the examiner he has been asking questions on the different areas, and amongst those different areas, one of them is basically the classification of instrument into financial liability or equity. That's one of the area that the examiner has been focusing upon a lot. So you should be able to, when you are doing financial instruments, you should be able to do this specific focus, that what is basically the distinguishing factor in a financial liability and in the equity. So I could just give you a good guidance on this also, which is basically that when we talk about the equity, so the key feature of the equity is that there is an absence of obligation to pay cash, of obligation to pay cash. So when you are going to be doing it, just make sure that you do keep this area in mind. That's an important area. The second thing is about the compound financial instrument, that how exactly are you going to account for the compound financial instrument. Now there are two, three things with respect to compound financial instrument. First of all, basically, the separation into financial liability and equity. The second thing is that you should learn that how to calculate the effective rate. At times there is another things which is like the transaction cost. So at times what happens is that the transaction costs which are incurred initially, so you should know how to split them into the equity. You should know that how to split them into the liability, and then how to calculate the revised effective rate. So that's also important areas when it comes to compound finance instrument. The third thing is that the measurement, I think you do know that you should know that what is at fair value through OCI, what is at fair value through P&L, and what is at amortized cost. The key area is the amortized cost. The key area is the amortized cost. You should know that how the financial assets and the financial liability at amortized cost are actually measured. Now, a very important area which is examined a lot is about the impairment of financial assets. And what I would actually suggest to you is that you should try to even read through the some of the articles on this financial assets impairment, because that's an area which the examiner examines a lot. So like you should know that how the impairment of financial asset should be accounted for. You should focus a lot on this. Fifth is derivatives, which are not examined a lot. And lastly, the hedge accounting. So with respect to the hedge accounting, I have seen the fair value hedge to be examined a lot. But since you have actually asked for the cash flow hedge, so I'm just gonna talk about the cash flow hedge, that how exactly is it. But I've just given you the overview, the area of focus, that what are the key areas which the questions on financial instrument are examined. Okay, now let me just tell you that what exactly is a cash flow hedge. So when we talk about the cash flow hedge is basically the hedging relationship entered to hedge against adverse movement of cash flows in a highly probable future forecast transaction. So basically, what happens is that if there is a highly probable future forecast transaction, and if you would like to hedge yourself against the adverse movements in the cash flows of that highly probable future forecast transactions, so what is actually going to happen is that you would say that it's a cash flow hedge. Now, I'll give you an example of the cash flow hedge. That what could be an example of cash flow hedge? Maybe let's say you want to buy an equipment, you want to buy an equipment in in let's say uh, 6 months time. You want to buy an equipment in 6 months time, and you are yourself a company based in USA, and you want to buy this in yuan, the Japanese currency. Now what happens is that you have a risk that there could be an adverse movement in the price of this specific machinery, this specific equipment, or this specific currency also, which could ultimately have an impact on your organization's cash flow. So as per the requirements of the IFRS, what we do is that we remeasure the hedging instrument to fair value at each reporting date. Effective portion of gain is taken to OCI. The ineffective portion of gain is taken to P&L. Furthermore, upon undertaking transaction, the amount accumulated in OCI is either adjusted against cost of asset or transferred to P&L as asset is consumed. So what actually happens is that, let me just guide you a bit. That when we talk about the cash flow hedge, a cash flow hedge is basically a highly probable future forecast transaction which you are hedging. And what you need to do is that you need to make sure that you remeasure the hedging instrument at fair value at each reporting date, and the effective portion of hedge should be taken to OCI, and the ineffective portion of the hedge should be taken to P&L. Now, what is the effective portion? What is the ineffective portion? I'm just going to guide you. Plus, what happens is that upon undertaking the transaction, the amount accumulated in OCI is either adjusted against the cost of the asset or it's transferred to P&L as the asset is consumed. Now, let me just give you a bit of a guidance on this, that how it actually goes about. Now, see, for example, let's say that you entered into a forward contract to buy yuans whenever you're gonna buy. Now, right now, the value of equipment and the value of forward contracts are like this. Let's say the value of forward contract is 0. The value of equity, the equipment is, let's say, in terms of dollars, it is 300. Now, when the quarter one comes in, the value of the equipment has become 345,000, whereas the value of the forward contract has become 52,000. So what happens is that there is actually a movement of 52,000. There is actually a movement of 45,000. There is one portion which is effective and there is one portion which is ineffective. Now, what is the effective portion? You compare the movement in both the hedged item and the hedging instrument. The lower amount is actually effective and the higher amount is ineffective. The lower amount is effective and the higher amount is ineffective. The remaining amount is ineffective. So in this case, 45,000 is effective, 7,000 is ineffective. 45,000 is effective, 7,000 is ineffective. Now, what actually happens now is that at the quarter two end, this has become 363,000. At the quarter two end, this has become 363,000. So if I say 363 minus 345, it actually is an 18,000, which is the difference. And here what happens is that this has moved to 66,000. So when I say this difference, this is 52 minus 66 gives you 14,000. So the lower amount in these two is 14,000 and that's actually the effective portion. Now the ineffective portion is gonna be zero. Why? Why? Because we are only recognizing, I repeat, we are only recognizing the hedging instrument. I've entered into forward contract only to hedge against this purchase of asset. So what am I gonna do? At the end of quarter one, my double entry is gonna be, I would say, the financial asset debited by 52,000, OCI credit by 45,000, PNL credit by 7,000. And at the end of quarter two, I would say that the financial asset is gonna be debited by 14,000 and the OCI is gonna be credited by 14,000. You get it now? Rebecca, you got it now? Right? You understand the effective and ineffective portion also? Okay. Now one more thing. So basically once you will buy the asset, this OCI would be adjusted against your asset's cost. Once you buy the asset, the amount which is held within the OCI is going to be adjusted against your assets cost. That's something that you would have to do. Okay, Rebecca, do you have how did ineffective portion become zero? Okay, you see, let me just explain to you people. Originally the price was zero, right? Now here what happens is that at the end of quarter one, the item which we were hedging has moved by 45,000, whereas the instrument has moved by 52,000. So what actually happens is that the instrument is what is recognized in our financial statement right now. So we are going to recognize the instrument at 52,000. But the movement on the instrument was 52,000 and we only needed 45,000 to hedge against our asset. So resultingly 45,000 is effective. The remaining 7,000 is ineffective. Similarly, when we talk about quarter two, when we talk about quarter two, the instrument has moved by 14,000. The hedged item has moved by 18,000. Now, so the instrument's movement is what we are recording. The instrument has moved, but it has not moved beyond what was needed. It has moved less than what is needed. So it's good enough. All is effective. It is all going to offset the loss that we are going to incur in the purchase of asset. Like you see, you could have purchased the asset for $300,000. Now you are purchasing asset for 345, whereas the instrument has moved by 52. So there is an ineffective portion in the movement. Now the assets value has now moved by 18,000, whereas instruments have moved by 14,000. So therefore what happens is that this whole 14,000 would be offsetting the loss of 18,000. You get it? Yeah, Ibrahim, do you get it now? So I had multiple people. Um, Ibrahim, you had a issue, effective, ineffective. Dion Collymore, is it clear to you? Anishta, is it clear to you? Yeah, that is because if there is an instrument has more movement, that remaining portion is ineffective because that was not needed. Okay, Ibrahim, thank you. Anishta, is that okay to you? Dion Collymore, is that okay to you? Okay, lovely. Alhamdulillah. Okay, Rebecca, is there any other query that you have? Okay, you see the only difference with the fair value hedge is both the gain or loss on the hedged item and the hedging instrument is taken to P&L. That's it. That's where the difference is. Because under the fair value hedge, what would happen is that you would have either a recognized asset or a recognized liability. So when you have a recognized asset or a liability, let's say you have an inventory, you have hedged that inventory. So every reporting date, you would remeasure the inventory at fair value, gain or loss taken to P&L, Every reporting date, the instrument that you are using to hedge the inventory, whether that be call option, whether that be put option, whether that be swap, whether that be forward, whatever, you would remeasure it and gain or loss taken to P&L. So it's going to be matching. Similarly, if you have a debt instrument whose gain or loss goes to OCI, so you would have the hedging instruments gain or loss going to OCI also. So just remember the with respect to the fair value hedge, you remeasure both because you have got a recognized asset or a liability which you are hedging. So you recognize the gain or loss on that into the P&L and gain or loss on the derivative into the P&L. Unless and until you have a debt instrument which is remeasured at fair value through OCI, so you remeasure the hedging instruments gain or loss to OCI also. Right? Lovely. So, so is that okay to you people? Now, who else do I have? I've got Rashid Abbasi. Rashid, is there any query that you have? Okay, I've got multiple questions right now that are being asked. Kilani, can you please define effective and ineffective? Can we have enough questions to practice that aspect? I mean, hedging derivatives. Okay, in the past paper, only once there is a testing of cash flow hedge. I would try to make sure that at the end of this session, maybe by tomorrow, I could share that with you people. So there has been only one instance that the cash flow hedge has been examined. And you could refer to your books like BBB or Kaplan also has got one example for the cash flow hedge. They don't have much of the examples for that. Okay, Ibrahim, with respect to IFRS 9, I just explained everything that what is examined. So majorly the classification of the financial assets and financial liability or equity means the distinction between equity and liability is a very frequently tested area. Then for the impairment of financial asset, that's also an area. That's what the majorly theoretical areas are. Okay, I've got Portia Mogvira. Portia Mogvira. You have any queries? Uh-huh. Okay, so you are unable to classify whether the deferred tax is going to lead to, I mean, like the temporary differences are going to lead to deferred tax asset or a deferred tax liability, right? That's where you're having an issue? Mm-hmm. Okay, I'll just give it a try. Obviously, I cannot go through the whole of IS 12 right now, but I'll just give it a try, right? There are two, three, four important things. One of them is when you talk about the deferred tax. So you need to understand that there are multiple aspects that you should know. One of them is a carrying amount, which is the accounting net book value. The second thing is the tax base, which is the tax net book value of an item. Then you have got something which is called temporary difference. What is this temporary difference? It's the difference between the carrying amount and the tax base. So when there is a difference between, are you people able to see my screen? Okay, it's stuck. Okay, just wait a bit. Okay, guys. So the next query is about IS 12. So I cannot go through the entire IS 12 right now, but I can give you some hint, some guidance as to what are the things that you should look at if you want to do this IS 12 queries. First of all, the first thing is that you should know that when we talk about the carrying amount, there's a carrying amount which is the accounting net book value. There's a tax base which is the tax net book value. Then there is this temporary difference which is called the difference between the carrying amount and the tax base. These temporary differences are classified as two types of temporary differences. These could be considered as taxable temporary difference and these could be considered as deductible temporary differences. So when we talk about the taxable temporary differences, the taxable temporary differences would lead to future tax expenses. Whereas the deductible temporary differences are going to lead to future tax savings. So there are going to be future tax savings, there could be future tax expenses. So when I talk about the taxable temporary differences, resultingly what happens is that you have got the taxable temporary difference multiplied by tax rate, you end up getting a deferred tax liability. You end up getting the deferred tax liability. And when there is this deductible temporary differences multiplied by tax rate, what you end up getting? You end up getting deferred tax asset. So I repeat, there could be a deferred tax liability, there could be a deferred tax asset. Now what else is there? So basically, a deferred tax asset or a deferred tax liability is what you need to understand, that depending upon what you have, if you have got a taxable temporary difference, it's a deferred tax liability. If you have got deductible temporary differences, it's a deferred tax asset. Now what next is there? The next situation that we have is that we need to understand one thing, which is basically there are certain rules for the classification of the temporary differences, that how could they be taxable, how could they be deductible. So always remember, if number one, carrying amount of an asset is greater than its tax base, it's a taxable temporary difference. The second thing is that if the carrying amount of an asset is less than its tax base, it's a deductible temporary differences. Third is that if carrying amount of liability is greater than tax base, it's a deductible temporary difference. And the fourth one of them is if carrying amount of liability is less than tax base, it's a taxable temporary difference. Now you know this thing, that the liabilities are being classified, or the deferred tax liability or the deferred tax asset actually arises on the basis of classification of the temporary differences into the taxable and into the deductible. So I repeat, what happens is that the classification of the assets and the liabilities actually is on the basis of the temporary difference classification. So it's very important that you should remember these rules. And I tell the students that there is only one rule that you have to remember, which is rule number 1. And every other rule is opposite to it. So now what does it mean? It actually means if the net book value of the asset is 500,000 and the tax base of the asset is, let's say, 420,000. So this means the net book value is greater than tax base. So this 80,000 is your taxable temporary difference. This 80,000 is your taxable temporary difference, right? What is it? It's your taxable temporary difference. You understand this? Now let me just guide you something. If you remember one rule, you would remember all the other rules because all of them are opposite to it. So can you just have a look at it, please? Yeah, Portia, is that okay to you right now till here? Right? You do understand that how you could remember the rules, right? Right? Just remember number 1 and rest of them are opposite to it. You could see that if carrying amount is greater for assets, it's a taxable. But if carrying amount is less than for the asset, it's deductible. In the case of liability, it's opposite. Now, let me just guide you now. Now, basically what happens is that your query was that at times I don't understand that when a deferred tax implication is going to arise. So I can just give you a very important hint that when can you know that the deferred tax is going to arise? Whenever the accounting treatment is not equal to the taxation treatment. I repeat, whenever the accounting treatment is not equal to the taxation treatment, so resultingly what happens is that deferred tax would arise. If the accounting treatment of any specific transaction is similar to the tax treatment, no deferred tax would arise. The only deferred tax is only going to arise when there is a difference. Like for example, what happens is that what we actually do is that the fair value measurement, if I talk about fair value measurement, basically what happens is that when we talk about the fair value measurement, like under IAS 40 investment property, we do measure the asset to fair value, but the tax authorities, they don't accept the fair value measurement. I mean, the tax authorities, they don't accept the fair value measurement. So when the tax authorities, they do not accept the fair value measurement, so what's going to happen? If the tax authorities do not accept the fair value measurement, so resultingly there is going to be a deferred tax because the accounting treatment is different for the accounting and for the taxation. So there is obviously going to be deferred tax. So the key area that you need to understand is when there is the same accounting, no deferred tax. Whenever there is a difference in accounting, there is going to be a deferred tax. And then in that case, is it going to be taxable or deductible? So for that case, I've actually given you an idea that how you would classify the temporary difference to be taxable, how you would classify them to be deductible. Now there is somebody amongst the student who actually asked me that can you just explain the implication of IFRS 2 and deferred tax. So let me just guide you that what's the IFRS 2 and deferred tax implication. What happens is that, for example, if you have got equity settled or cash settled share based payment transaction, what do? Under the equity settled share based payment transaction, we record, let's say, a transaction like this. We say expense debit correspondingly equity credit. Now the tax authorities, what they do is that, and we do it over the vesting period. Like we might do it over 1, 2, 3, 4. We might do it over 2, 3, 4 years. That is the vesting period. But how the tax authorities they treat things is that the tax authorities what they do is that they allow you expense on the basis of interest value in the year options are exercised. So I repeat, what happens is that the tax authorities, what do they do? The tax authorities allow you expense on the basis of intrinsic value. Intrinsic value in the year the options are exercised. Now let me just guide you a bit about it. What actually happens with respect to the tax authorities is that um, what would the tax authorities do? Let me just guide you about it. So the concept of intrinsic value is that market value minus exercise price. So basically what happens is tax authorities would allow you expense in the future. So there is always a deferred tax asset that arises on the share based payments. I bet there is always going to be the deferred tax asset that is going to arise on the share based payment transactions. Now how is that deferred tax asset going to be calculated? So like for example, if there is a 3-year vesting period, let me repeat. Let's say if there is a 3-year vesting period, right? So in case if there is a 3-year vesting period, what is going to happen? For the 3-year vesting period, what is actually going to happen is that you would say that I mean for the 3-year vesting period, you would simply say that let's say calculate the intrinsic value at each year end. Let's say the tax rate we have is 30%, right? So if for example at the end of year 1 the intrinsic value of the options was 20 million, at the end of year 2 it was 27 million, and actually in the year 3 it turned out to be 24 million. Now what is actually going to happen is that you would say this 20 million multiplied by 1 upon 3, because this is the first year of the 3-year vesting period, multiply by 30%. So 20 into 1 upon 3 into 30%. So this actually gives you 2 million. So basically what happens is that your deferred tax asset carrying amount is gonna be 2 million. Your deferred tax asset carrying amount is gonna be 2 million. And deferred tax income is also gonna be 2 million year 1. Now what happens in year 2, you would say multiply 2 upon 3. Multiply by 2 upon 3, multiply by 30%. So now what actually happens is that 27 into 2 divided by 3 into 30% gives you 5.4. Now what actually happens is we are gonna say that the deferred tax asset is 5.4. Now what is actually gonna happen is that it's gonna be 3.4 million that's gonna be recognized as an income in this specific period. I bet 3.4 is the deferred tax income that's gonna be recognized in this specific time period. Just hold on a bit please. जी भाईजान बोलो. यार क्लास चल रही है, 12 बजे तक आऊंगा, तकरीबन 12:30. चलो सही है, बाद में बात करते हैं. अल्लाह हाफिज. Okay, now then what actually happens is that then you have got this multiply by 3 upon 3 into 30%. So basically it's actually gonna be what? It's actually gonna be what? 24 into 3 divided by 3 into 30% gives you 7.2. 7.2 minus 5.4 is 1.8 is what is actually gonna be shown. Do you get it now? 1.8 is the income that's gonna be shown. So just for the sake of your understanding, if I could just pass a double entry for any of the years, I could say that I could pass a double entry for year 2. I could simply say that the deferred tax asset is gonna be debited by 3.4 million, and I could say that the deferred tax income is gonna be credited by 3.4 million. Is that okay to you people? Okay, Portia, are you okay? I mean, I hope that you would have got some understanding of the taxation by now. You have any other thing, lady? Okay, lovely. Thank you very much. Okay. Sarah, I just explained the hedge accounting lady. You would get it in the recordings. I'm sorry, I cannot just go back to that hedge accounting again because then I would be missing out a lot of people. So I'm sorry about it, but I would just share the recordings with you, right? Okay, Rashid Abbas, you have a question from IFRS 9. Suppose we are recording financial asset on fair value through OCI. If in the year there is a change in fair value of asset and at the same time there is a stage 1 impairment, how do we account for this situation? Okay. If there is a fair value through OCI and if there is a change in the fair value of the asset and at the same time there is a stage 1 impairment, okay, you recognize the impairment loss in the P&L. That's the basic thing. You recognize the impairment loss in the P&L. Ibrahim Kalim, if a company has tax losses in year 1 and forecast profit after tax 6 years, company can get a tax on year 2, 1, 2, 3, what would the loss accumulate? Okay. Now there is one more since we are on to IAS 12 right now. I have one more query and that was basically the deferred tax asset on unused tax losses. So I could just give you a bit of a guidance on this. That what happens is that the deferred tax asset on unused tax losses shall be recognized to the extent that such losses would be available for adjustment against future taxable profits. So let me just repeat. The deferred tax asset on unused tax losses shall be recognized to the extent of that such losses will be available uh, for adjustment against the future taxable profit. Now, what does it mean? For example, your tax rate is 30%. You have accumulated losses of 20 million. Now, there is a limit that these losses could be carried forward to 4 years. Now what actually happens is that, I repeat, the tax rate is 30%. There is a limit that these losses could be carried forward for 4 years. Your forecast shows that profits in next 4 years are gonna be 16 million. Your forecast shows that the profits in the next 4 years is gonna be 16 million. So what happens is that you cannot recognize the deferred tax asset on this 20 million. This is only 16 million on which you could recognize the deferred tax asset. You cannot recognize on 20 million. So what are you gonna do? You're gonna say 16 million multiply by 30%. Gives you 4.8 million. So you'd say The deferred tax asset debit by 4.8. Deferred tax income credit by 4.8. Do you get it now? Okay, thank you. Okay, I'll just see. Okay, Sarah, I missed you out. So, do you have any other queries? I mean, one of the queries that you asked about edge accounting. So, I think that you would have to refer to the recordings once they are available by tomorrow. Do you have any other queries, Sarah? Okay, lovely. In case if you do have, do let me know, right? Okay, I've got this Peter Firi. I hope that I pronounced your name correctly. Peter Firi, do you have any queries? Okay. What if forecast loss is less than accumulated loss? Anishta, are you trying to say forecast profits or forecast loss? That's how the case is. You had an accumulated losses of 20 million and the forecast profits for the next 4 years are 16 million. They're less than the accumulated losses. So let's say if your forecasted profits are 30 million. So you would recognize deferred tax asset only on 20 million. Do you get it now, Anishta? Okay, lovely. Okay, the next I have got your name. The first and the last name is difficult, so I'll use the middle name Kilani. Kilani, how are you? Your queries, please. Good evening. Okay, okay. First of all, I will talk about the sale and leaseback that you just asked. So, with respect to the sale and leaseback, what I'm actually going to say is that when we talk about the concept of sale and leaseback, um, basically under the sale and leaseback, what does IFRS 16 says? IFRS 16 says the first thing that you have to use is that you have to see if the sale transaction meets criteria for revenue recognition क्या है? If the sale transaction meets the criteria for revenue recognition under IFRS 15. IFRS 15 is revenue recognition. So let's say in case if the sale transaction meets the criteria, the sale that you have entered into, if that meets the criteria for revenue recognition. Now what do you mean by meeting the criteria for revenue recognition? That means that probably the risk and rewards have been transferred to the asset. So let's say if the sale meets the criteria for revenue recognition under IFRS 15, what exactly are you gonna do? So as per IFRS, you are gonna recognize the gain and loss to the extent of right of use of the asset transferred. In case if the sale not meet the criteria, in case if the sale does not meet the criteria, so what is it you have to do? You have to recognize, you have to recognize amount received as financial liability. You have to recognize the amount received as a financial liability. So basically what happens is that you got to recognize either the gain or loss to the extent of right of use of the asset recognized, sorry, transferred, or in case if the sale does not meet criteria, you have to recognize the amount received as a financial liability. Now let's just try to understand things. For example, for example, uh, the net book value or the carrying amount of the asset was 100,000. The fair value there could be three types of situation. One of them is selling price is equivalent to fair value, case number one. The fair value is 125,000. The selling price is also 125,000. The present value of lease back transaction, like we have taken the asset back on the lease, and the present value of the lease back transaction, which is also called the present value of lease liability, is let's say 80,000. So what are we gonna do? We're gonna say, okay, what's the gain? The gain is actually 25,000. How exactly are we gonna recognize it? Let's just try to understand. How exactly are we gonna try to recognize it? Let's just try to understand this. Basically, what is gonna happen is that first of all, you need to calculate the right of use of the asset which is transferred. How do we calculate the right of use of the asset transferred? You see, this asset at a market value of 125,000. You sold the asset and you leased it back. So when you sold the asset and you leased it back, so basically what is going to happen is that you have retained some portion of this asset. What is the portion of the asset that you have retained? So that could be measured using this consideration that you are paying, which is 80,000. Now the consideration that you are paying is 80,000, right? So what are you going to do? You're going to say 80,000 is basically the right of use of the asset retained. So what are you going to do? You're going to say fair value minus lease liability divided by fair value. So it's actually going to be 125,000 minus 80,000 divided by 125,000. Resultingly, what do you get? 36% is the right of use of the asset that has been transferred. So how much gain that you're going to recognize, that's actually going to be 36%. I repeat, that's actually going to be 36% multiplied by the gain amount, which was 25,000, right? So hence resultingly, how much does it actually turns out to be? It turns out to be 9,000. Now, How exactly are you going to record the whole of it? You would say cash is going to be debited by 125,000. The asset is going to be credited by 100,000. The lease liability is going to be recognized by 80,000. The P&L is going to be recognized by 9,000. And then the balancing figure is going to be taken to the right of use of the asset. So if I try to establish the balancing figure, my balancing figure is gonna be what is gonna be 64,000. So I repeat, my balancing figure is gonna be 64,000. What is it gonna be? It's gonna be 64,000. You get it? My balancing figure is gonna be 64,000. Now, so this is the way to record the sale and leaseback transaction. I could just zoom out for all of you to have a look at it. It's like net book value was 100,000, the fair value was 125. Now this is how you actually recognize. Now a lot of you people would be like, we need to know that how the right of use of the asset is recognized. So it's very simple. You have transferred, you have actually transferred 36%. So if you have transferred 36%, you have retained 64%. So you could even say 64% multiplied by existing net book value, which is gonna be 100,000. So you will even get this amount to be like this. So there was one case where the selling price equals the fair value. I bet there is one case where the selling price equals the fair value. Now let's move a bit forward and let's talk a bit further. The next aspect is that selling price is less than fair value. Now what exactly could this be? Let's say your selling price, sorry, let's say your net book value is again 100,000. The fair value is 125,000. Selling price is 115,000. And the lease liability is again that 80,000. Now, what is actually going to happen in this scenario? When the selling price is less than fair value, what are you going to do? You're going to say if the selling price is less than fair value. I repeat, if the selling price is less than fair value, what is this indicating? The selling price being less than fair value is indicating that originally your gain should have been 25,000, but here your gain is arising to be 15,000. That means this 10,000 is lost somewhere. Now obviously there is a commercial transaction, it cannot be lost. You just cannot, I mean, why would you give up your gain? No one would give up their gain. You would never give up your gain. You get it? You would never want to give up your gain. So the question mark is that where is that amount lost? So for this you need to understand that that amount is actually not lost. It's actually somehow or the other passed on or incorporated within this whole thing. So what are we gonna do? We're gonna say, okay, this lease liability is 80,000, but that means we are actually giving up 10,000 more. We're giving up 10,000 more as a 80,000 plus 10,000 and divide by 125,000. So when you're going to be calculating this right of use of the asset transfer, it's going to be 28%. I repeat, it's gonna be 28%. It's gonna be 28%. Now try to understand something. So the gain that is going to be recognized is going to be on the basis of 25,000 into 28%, which is gonna be 7,000. And how would you recognize the whole of it? You would say cash debit by 115,000, asset credit by 100,000. The lease liability is gonna be credited by 80,000. The P&L is gonna be credited by 7,000. And the right of use of the asset is again gonna be the balancing figure. How much is this balancing figure going to be? Let's just try to see. It's gonna be 72,000. Do you get it now? And lastly, in case number 3, where the selling price is greater than fair value. So what happens is that when you are gonna be calculating the ROU transferred, you would simply say fair value minus lease liability divided by fair value. For the lease liability, what are you gonna do? You're gonna say whatever the lease liability minus the differential, which is the difference between selling price minus fair value. That's how you're gonna calculate. So here it means that we have actually got the extra money. So we have got the extra money. So whatever that we are paying, some portion is the extra money, the extra loan that is we are repaying. I bet some portion is the extra loan that we are repaying. So Kilani, I think that your query is answered with respect to sale and leaseback. Okay. Okay. For example, in this example, what happens is that let's assume that the selling price is 133,000, right? Now, what happens is realistically the gain should have been 25,000, but actually the gain arising in here is 33,000, right? So what are you gonna do? You're gonna say, first of all, let's calculate right of use of the asset transferred. So it's actually gonna be 125,000 minus 80,000 the lease liability, but here you have got actually what? You have got an extra 8,000 amount, right? So you're gonna minus 8,000 from it. So hence resulting divide by 125,000. So you could get the right of use of the asset transferred to be 42.4%, right? So the gain that you have to be recognizing is gain that you're gonna be recognizing is 25,000 into 42.4% gives you 10,600. Yeah, the ROU is always gonna be the balancing figure in this, right? Okay. Now you had one more query about the impairment. Is it the impairment of financial asset or is it the normal impairment? Okay. For the impairment of financial asset, I've already recorded one video, so I'm gonna share that with you. Impairment of financial asset. I'm just gonna share that video with you people. because the reason being that I have already recorded that video, so you don't have to worry about it because that's already gonna be available. Right, in case if you wanna see, I can just show you people also. Chrome, where's the Chrome here? You've got YouTube. I would make sure that my team shares this also with the YouTube. You've got a Scriber Academy. And when you go to Scriber Academy, what happens is that in this Scriber Academy, you could just go on to the playlist, and from the playlist, you could just sort it by latest video added, let's say. So when you're gonna sort it by latest video added, you would see a playlist on SBR, the strategic business reporting. You view the full playlist, and when you view the full playlist, there are multiple things already available in that. Uh, so I could just tell you people that there is this crowdfunding, impairment of financial asset is also available in here, plus sustainability reporting, ethics, conceptual framework. There are many things that are available in here, many consolidation question, etc. So you people could just review this uh, this playlist on the Scriber Academy page. We would just make sure that we would try to share it with you people also. Okay, what else is the query that you have? Okay, Shahroz, you are asking that. Okay, just wait a bit, Kilani. There's a question related to leases, so I'm just gonna answer that. Okay, you are asking that what is GIL, what is NIL, what is UFI? So GIL is gross investment in lease. NIL is net investment in lease. UFI is unearned finance income, right? So you've got one which is gross investment in lease. You have got net investment in the lease, and the third one of them is unearned finance income. Now, what actually happens is that when we talk about this gross investment, net investment, unearned finance income, let's just try to understand this. Basically, gross investment in the lease is your lease payment plus unguaranteed residual. Your net investment in the lease is present value of gross investment in the lease. And your unearned finance income is that gross investment in the lease minus net investment in the lease. These terminologies are used for the lesser accounting. These terminology shadows are used for the lesser account. Okay, Kilani, what else do you have? Okay, okay. Basically, with respect to it, what I can actually tell you is that like the ratios like EBITDA, the earning before interest, tax, depreciation, amortization, that's one of the key ratios. Then what happens is that there are some non-financial ratios or the non-financial indicators which the examiner could ask. And that could be anything. That could be the customer satisfaction ratio. that could be the market share, etc., etc. So, but generally, what I would suggest you to do is that just make sure that when you don't have to worry a lot about many ratios. It's just EBITDA that's important. A few other ratios which the examiner obviously gives a formula about. He discusses them in the scenario. Now, one thing is that at times you can get the formula wrong. But let's say whatever the formula that you have written wrong, if you can get the interpretation right, like for example, the EPS that I should have calculated would have been $3, but I calculated $1.2. Last year EPS was, let's say, $2.5, or let's say last year EPS was $1. So now what I have actually done is that I have now, oh sorry, last year EPS was, let's say, now last year EPS was 2.5. The correct answer for this year is 3. That means the entity's performance has improved. But I actually got 1.2. But I got 1.2. And now I compared this 1.2 with the 2.5 of last year. And I went on to write things and things and things. And I gave valid arguments. I will get full marks. In fact, not full marks. I will lose 1 mark for the EPS calculation, but I will get marks. Because I'm talking sense. I'm talking the relevant things. So always think that the examiner, what he or she is gonna do is that he is not going to take away all the marks from you. He's gonna give you marks even if you've got the wrong calculation. So you don't have to worry much about it. Okay, what's your last query? Okay, Sheroz, you have got any queries? Okay, Mike Akoto, how are you? I think that you have sent several queries earlier also. So let me just follow that what were your queries so that I could actually answer them accordingly. You talked about impairment in financial instrument. I told you that there is a video that I've already recorded, so I'll just share that with you people. Mike Akoto, you also asked about asset ceiling in IS 19. So let me just guide you that what is this asset ceiling in IS 19. Point 100. Fair value of plan assets is, let's say, 70. So we get 30. This 30 is going to be considered as a deficit, and this deficit is going to be shown as a defined benefit liability in your company's financial statement. However, and majority of the times, this is how the situation is. I repeat, majority of the time, this is how the situation is. Now, similarly, what actually happens is that there could actually be a situation when you can have, let's say, 115. You could actually have a surplus of 15. This surplus would actually lead to defined benefit asset. This surplus would actually lead to defined benefit asset. Now, let me just give you something about it. When we talk about the defined benefit asset, let me just show you something. As per the IAS 19, you cannot recognize the entire amount of asset. There's a limit to which the asset could be recognized. And that limit is called ceiling. Now, what does this asset ceiling says? That the maximum amount at which defined benefit asset could be recognized is the lower of. Lower of what? Amount as per normal calculation or the present value of benefits from future refund slash reduced contributions. So basically what happens is that there is a maximum amount. I bet there is a maximum amount at which defined benefit asset could, that's what the ceiling is. So when we talk about ceiling, it's a maximum limit. Maximum limit is either you can recognize at this 15 million or you calculate present value of benefits from the future refunds or present value of the benefits from the reduced contributions. So that's how you have to do. Okay, there are questions that the students are asking. Where are you going to share them with us? Yes, they're going to be shared on email. You will be added to a WhatsApp group. They will be shared on the WhatsApp group also. Cindy Lachman, can I have to leave? Can you? Yeah, recordings will be shared. Cindy, don't worry about it. So, Mike Akoto, are your queries answered now? Okay, lovely, lovely. Okay, Imran Ali, you have any queries? Yeah, hello. Do you have any query? Yeah. Mm-hmm. 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 Okay. Okay, let me show you the difference. Let me show you the difference. This is cost. This is NCI. This is fair value of assets. So whether you prepare the full goodwill or whether you prepare the partial goodwill, the formula is the same, right? That's what is confusing you. Now let me just guide you that NCI could be measured either using two methods. Either the NCI could be at fair value. So when the NCI is at fair value, it's called full goodwill. The NCI could be at proportionate share, and this is called partial goodwill. There could be full goodwill, there could be partial goodwill. Now, How exactly this NCI calculation differs under both of them? The formula appears to be the same, but the formula is not the same. Because when we have got NCI at fair value, we say number of shares of NCI multiplied by market value of subsidiary share. But when we talk about the NCI at proportionate basis, we say NCI percentage multiplied by fair value of net assets. So at one point NCI is at market value. At one point we say, okay, this is the total value of the net asset 100 million. 25 belongs to NCI, so 25 million is NCI. So it appears to be same, but under fair value method, it's the different way of calculating it. Under the proportionate method, it's a different way of calculating it. You get it? Yes, the only difference is calculating NCI. Because what happens is that when you calculate NCI at fair value, so you are calculating goodwill for both the parent and the NCI. But if you are calculating NCI at proportionate share, you are only calculating goodwill for parent. Now, what I can do is that I can demonstrate you through the example because I usually don't get into these concepts because frankly speaking, nowadays, ever since that ACC has converted into quarterly attempts, it has become very difficult for students to absorb the whole context within 3 months. So as a tutor, we have also reduced our teaching to, I mean, like we don't get into a lot of concepts all the times because when you get into all of the concepts, it becomes problem with the students that how would they cover all the concepts. So I myself try to tell the short story. But since you are actually confused and you wanna know the long story, so I'm just gonna share that with you now. So let me just guide you about it. Basically, what happens is that let's say let's say parent acquired 75% subsidiary for $100,000. Fair value of net assets of subsidiary is dollar 110,000. Number of shares of subsidiary are 10. Market value of each share is $13.5. Now, this is the scenario. On the basis of this scenario, first of all, I would do the calculation in the normal manner. Then I would explain to you the concept. So if I have to calculate full goodwill, if I have to calculate partial goodwill, cost is gonna be 100,000. NCI is gonna be 10,000 into 25% into 13.5. Gives you 33,750. The fair value of net assets is 110,000. Gives you 23,750. Right? Similarly, if I had to calculate the partial goodwill, I would have said cost 100,000. The NCI is gonna be 25% into, now, so you've got one full goodwill, one partial goodwill. Now, this is the normal calculation that you know, but you want to know the logic, so I'm going to explain to you logic now. Now say, see the logic. Cost of investment 100,000. Share of net asset acquired by parent. So of the 110,000, as a parent you have acquired 75%. That means you have acquired 82,500. Now 17,500 is actually gonna be the goodwill which is parent share. Then what happens is that you say fair value of NCI, which we already know, 10,000 shares into 25 into 13.5, 33,750. Then we say NCI share of net assets. So of the 110,000, 25% belongs to NCI. Gives you 27,500, right? You get it? So this is going to be goodwill NCI share. Gives you 6250. Now when you add up both of them, you end up getting full goodwill. This is the logic of this full goodwill. Get it now? Get now? We don't explain this logic. I mean, I don't explain this logic because I think that it's complicating things for the students. It's just that you were confused. That's why I explained. Yeah. So, but you just have to focus on this. Follow this approach. That's it. Why do you have to confuse? Why do you have to complicate things for yourself? You see, Imran, there are two approaches. One of them is, do you want to achieve a gold medal? Do you want to achieve a position? Yeah, I'm asking you, do you want to be a position holder? No, you just want to pass, right? At the end of the day, what matters is you are an ACCA, right? So just try to be an ACCA, right? I'm sorry if that hurts, but I'm just trying to tell you that just try to take the things as they are. Don't try to just decode the things a lot. Okay. Um, Next I have got Ibrahim Kalim. Ibrahim, you have any questions? Okay, good enough. I've got somebody who is IPH, probably iPhone. You have any questions? Okay, Elizabeth, do you have an, okay, sorry, iPhone, IPH. Okay, sorry. You can unmute yourself, please. Sorry. Okay, good enough. You're practicing well now, lady. You're the one from Mauritius, right? Okay, good enough. Uh, Thank you. Now, I've got Edis. I'm sorry, I don't know if I'm pronouncing your name correctly. Ediswa. Ediswa. Okay, I'll just see if I have forgotten anyone. Okay, Kumar, Gaurav, the few people who have joined, but they've not joined with the audio. Okay, IPH, I explained about the current issues, and I told you that the current issues at the initial phase, I did explain that refer to the Kaplan revision kit. You will get the current issues. Okay, Selvin, I referred to one of the playlists. In this specific playlist, this Moist group is the group cash flows. I've explained the group cash flows in detail in this specific thing. So you may refer to this, please. Okay. Okay, guys. So I think that's it for today. Again, my agenda was that I just wanted to have a conversation from you people, and uh, I wanted to actually explain to people uh, what you want to know, right? So that's why I adopted this approach, and I hope that you all admired this approach and you had a beneficial session. Um yes, Sheroz, I think that there are few students in the group. I'm sorry, I'd been traveling a bit for some time. Basically, I had some urgency, some matters which actually just came unsolicited. So that's why I just could not be very, very active on the group, but I'll just do a class on the fair value measurement, no worries. So, would really appreciate if you people could have your feedbacks on the session, that how did you find the session and how and what do you understand about the session.